Stiefmüller, Finance Watch.
Thank you, Mr. Chairman, for inviting Finance Watch to speak at this hearing. We welcome that the proposed banking package incorporates important new international standards into European law. But I would like to start by addressing some of the underlying assumptions that we think deserve to be questioned. First, despite some progress, bank capital has not been restored to consistently safe levels. The European banking sector still has around 1 trillion euros of non-performing loans to absorb. For this and many other reasons, European banks continue to be less well capitalized than most other major economies. Secondly, bank capital regulation is not slowing down the economy. At this stage, the availability of bank credit is in fact not as high a priority problem for European SMEs as others. Where credit shortages do exist, they appear to be largely structural, for instance linked to non-performing loans, rather than a result of regulation. What still holds true, however, is that well-capitalized banks fund themselves on more favorable terms than weak ones, and are more likely to lend to the real economy. Third, the problem of banks being too big to fail has still not been resolved. 10 years after the last crisis, citizens are once again faced with a bill for tens of billions to shore up failing banks. We need to ensure that resolution is applied as intended, that systemically important and significant banks are resolvable, and that structural impediments to resolvability are removed. We need to ensure that the European banking sector can become healthy and profitable again, without losing diversity and competitiveness. Banks need to focus once again on competing on the strength of their assets, which means better products, better service, better lending decisions, not on optimizing capital. Finance Watch has recommendations on all of these points. Turning to the proposal, Finance Watch is aware of the burden of compliance for smaller participants in the banking market. The objective should not be, in our view, to obtain less granular data or make do with less transparency, but to have fewer and simpler reporting processes. We welcome the proposed introduction by the EBA of a harmonized compliance tool, but would like to see a more ambitious approach leading towards a single point of contact for regulatory reporting, operating under the once-only principle. In addition, we would like to see a mandate for EBA to develop a set of unified European templates for statutory accounting, regulatory and financial markets reporting. We believe that the proposed definition of small institutions should be more differentiated and combine qualitative and quantitative criteria, mirroring the SII regime, i.e. a combination of absolute and relative size criteria, as well as criteria related to the institution's business model and risk profile. There needs to be a more informed discussion on the proposed review of the Pillar 2 regime, including Pillar 2 guidance. Pillar 2 guidance has been introduced into supervisory practice by the EBA and the ECB in 2016 already. At the stroke of a pen, binding CET1 capital requirements for significant Eurozone banks in the SSM were reduced by 23% on average. If the Parliament is expected to do more than rubber stamp that fait accompli, it should be provided first with the necessary factual basis, and we would recommend an in-depth review of the recently adopted regulatory practice, including a comprehensive impact assessment, before adopting these proposed sweeping changes into law. We also consider it problematic to introduce major changes to the prudential regime, such as the deletion of Article 103 CRD without having completed the pending review of the macroprudential policy framework. Harmonization of the macro and microprudential frameworks, which we strongly support, should go hand in hand to avoid regulatory blind spots. We would therefore call upon the legislators to postpone the proposed amendments to Section 4 of Title 7 of the CRD, until a comprehensive proposal for the harmonization of both micro and macroprudential tools has been developed and discussed. Finance Watch welcomes the introduction, at long last, of a binding leverage ratio. However, it is worth bearing in mind that a leverage ratio of 3% corresponds, on average, and only just, to the minimum risk-weighted Tier 1 capital requirement under Basel III. For systemically important banks, a higher leverage ratio is needed. The introduction of the TLAC framework is an important step forward in making resolution feasible. But even the most elaborate resolution framework is useless if it is not acted on when the need arises. We would therefore advocate once again a review of the existing precautionary recapitalization rule, which we believe is a major hindrance in putting the BRRD into practice. We would caution against deviating from FSB and Basel Committee standards. To do so would compromise international cooperation on banking regulation and undermine the EU's position in future negotiations, as well as the long-run resilience and competitiveness of the EU banks. We believe the European banking sector is not yet in a condition that will permit significant concessions in terms of lowering binding capital requirements. Finally, we will call upon the legislator to review obstacles in the BRRD resolution regime. I'm wrapping up. In the BRRD resolution regime, and ensure that it can be applied safely and consistently to facilitate the recovery of the European banking system. Thank you.